What if I told you there's an investment that has made ordinary people millionaires, people with no finance degree, no stockbroker, and no idea how to pick stocks? It's called an index fund, and by the end of this video you'll understand exactly what it is, how it works, and why it's probably the best investment most people will ever make. Here's the simplest way to think about an index fund. Imagine you want to own a piece of every major company in America: Apple, Microsoft, Amazon, Google, Walmart, all of them. But buying shares in every company individually would cost a fortune and take forever to manage. An index fund does that for you automatically. You put in $1, and that dollar gets spread across hundreds of companies at once. That's it. Let's back up for a second. What's an index? An index is just a list. The S&P 500 is an index. It's a list of the 500 largest companies in the United States. The Dow Jones is an index, a list of 30 big industrial companies. These indexes were created so people could track how the market is doing overall, not just one company. An index fund simply buys every stock on that list. If the S&P 500 has 500 companies, the fund owns tiny pieces of all 500. When those companies collectively go up in value, the fund goes up. When they go down, the fund goes down. You're not betting on one horse, you're betting on the whole race. Now here's where it gets interesting. Why is this better than just picking stocks? Let's say you decide to pick stocks yourself. You study companies, watch the news, read reports, and choose what you think are the best investments. Studies show that even professional fund managers, people who do this full-time, with teams of analysts and millions in resources, fail to beat the S&P 500 index about 90% of the time over a 15-year period. 9 out of 10 professionals lose to a simple index fund. Why? Because markets are incredibly efficient. Every piece of public information about a company is already priced into the stock. You're not going to find a hidden gem that thousands of Wall Street analysts missed. The index fund wins not by being clever, but by owning everything and keeping costs low. Here's the uncomfortable truth about stock picking. Over any 15-year period, roughly 90% of actively managed funds underperform the S&P 500. Not because the managers are bad at their jobs, but because the market is so competitive that it's nearly impossible to consistently outsmart it. Index funds win by not trying to be smart. They just own everything, forever. Let's talk about fees, because this is where most people lose money without realizing it. When you buy an actively managed fund, one where a team of people pick stocks for you, they charge a fee. That fee is called the expense ratio. A typical actively managed fund charges between 0.5% and 1.5% per year. That might sound small. But let's do the maths. If you invest $10,000 and get 8% annual returns over 30 years, you'd end up with about $100,000. But if the fund takes 1% a year in fees, you end up with only $76,000. That 1% fee cost you $24,000, almost a quarter of your final balance. Index funds, by contrast, charge almost nothing. Vanguard's S&P 500 index fund charges just 0.03% per year. That's 3 cents on every $100. Over 30 years, the difference in fees alone can add tens of thousands of dollars to your balance. So how do you actually buy an index fund? Step 1. Open a brokerage account. In the US, the big ones are Vanguard, Fidelity, and Charles Schwab. They're all free to open and have no minimum balance requirements. Step 2. Search for an S&P 500 index fund. The most popular ones are VOO from Vanguard, FXAIX from Fidelity, and SPY from State Street. Any of these will do, they all track the same index. Step 3. Buy as much or as little as you want. Fidelity and Schwab let you buy fractional shares, so you can start with as little as $1. Step 4. Set up automatic contributions. Even $50 a month invested consistently will grow into something significant over time. You don't need thousands of dollars to start investing. Fidelity and Charles Schwab both offer fractional shares, which means you can buy a piece of an S&P 500 index fund for as little as $1. Set up a $50 automatic monthly contribution, and you're an investor. That's the whole setup. Now let's talk about time, because this is the most powerful thing working in your favor. If you invest $200 a month starting at age 22 and earn an average 8% annual return, by age 62 you'll have about $702,000. You only contributed $96,000 of your own money, the rest, over $600,000, came from compound growth. If you wait until age 32 to start, just 10 years later, and invest the same $200 a month, you'll end up with about $305,000 by age 62. You invested the same amount per month, but waiting a decade cost you nearly $400,000. That's the power of compounding. The index fund doesn't care who you are, how much you earn, or whether you understand finance. It just grows, as long as you start early and leave it alone. Let me answer the most common question: what about crashes? The stock market crashes. It always has and it always will. In 2008, the S&P 500 dropped 38%. In March 2020, it dropped 34% in 5 weeks. Every time, people panicked and sold. And every time, the market recovered and went on to new highs. Here's the key insight: a crash only hurts you if you sell. If you hold an index fund through a crash, the loss is temporary. Historically, the S&P 500 has never failed to recover and go higher over any 15-year period. If you're investing for retirement, short-term drops are noise, the long-term trend is up. So let's recap. An index fund buys every company in a market index automatically. It beats almost all professional stock pickers over the long run. It charges almost nothing in fees. You can start with as little as $1. And the most important ingredient is time. Warren Buffett, one of the greatest investors in history, has said multiple times that for most people, a low-cost S&P 500 index fund is the best investment they'll ever make. If that's good enough for Buffett to recommend, it's probably worth taking seriously. Start today. Even small amounts. Let time do the heavy lifting. If you found this helpful, the next video in the series covers the 50/30/20 budget method, a great way to find the money to invest each month. See you there.